What's up, everyone? This is D the Firefly, hoping to get you financially fit. Here representing the FIRE movement, financial independence, retired early. Today, I want to talk about two pretty basic forms of investing that gotta happen if you want to grow wealth. If you're like me, you came from nothing, and you're wondering, how come some people have money? How come some don't? At the end of the day, it comes down to investing. I didn't even know what investing was a year or two ago. My cousin asked me, hey, how are you going to invest? And I thought, what, like hang out with the family? I'm investing time in y'all, right? Investing with money is a little different. So there's two pretty tried and proven ways of investing. There's the stock market, there's real estate. So today I'll talk about both. I just want to make some brief bullet points and leave y'all with some key takeaways. So hopefully this can be a little less scary. In the stock market, if you'll see the US stock market over time, it looks like this. Hopefully I have a picture up on the screen right now. But you'll see like some years it goes up, some years it goes down. We got hit pretty hard in the 1920s, Great Depression. We got hit pretty hard in '08, the Great Recession. We got hit pretty hard at the dot-com bubble, right in the middle there. I forget the year. I'm not looking at the screen as I'm reading this. But it should be 80s, 90s. I think it was around 2000. And so, you know, if you're going to be investing in stocks, it's going to be a bumpy ride. Sometimes it's going to go up, sometimes it's going to go down. But overall, the market tends to increase. So let's talk about what's in the stock market if you choose to invest that route. You've got something called stocks, aka equities. That's just pieces of a company that you own. I'm sure you've heard of buying stocks before. Maybe you haven't. But you can buy like a piece of Disney. Say they had 14 million shares. I'm not really sure how much they have. That's something I can Google. You would own 1/14 millionth of the Disney company. Stocks are nice because they generally tend to raise in value over time, especially if you invest in a good company. On the other side, you have bonds, also known as debt. When a company is trying to start a business, say they need $1 million to start up, they only have 600,000. They'll put out 400,000 in bonds. Does that add up? 600, 400? Yeah. So you can buy a piece of their debt, and they guarantee to pay you back at a certain percentage rate. They tend not to go higher than 3%, which over the long term has been the general market rate of inflation. You're not gaining any money, you're not losing any money as far as spending power goes there. The two other ways to invest in the stock market are mutual funds and ETFs. I still get them confused, but at the end of the day, I think ETFs you can trade at any time during the day. They tend to have lower fees. Mutual funds, you have to trade at the end of the stock trading day. They tend to be more actively managed, like someone has to make a mutual fund and put it together, so it's going to have higher fees. And in general, investing in the stock market, I'll go over the rules to that one day, but you can expect a rate of return of 7% over the long term. By long term, I'm meaning 40 years of retirement. You start at like 18 or so, expect to retire at 65. So let's say that's probably more like 50 years of retirement. That's been, I guess, the traditional average in the past. There's no guarantees about the future. I'm not a fortune teller. I'm just replying from the rules. Warren Buffett's done research on this. Financial teams have done research on this. And we seem to get the 7% number. Mutual funds and ETFs are collections of both stocks and bonds put together in a fund that you can buy as a package. Now, there's a difference between investing and buying a house. Now, buying a house can lock in your price before, inflation and, the development of a city increases the cost of your rent. Now, when you buy a house, you do lock in rent at whatever price it was at that time. So say you earn more money in the future, but your rent stays the same, that is going to save you money over time. But unless you intend to rent a property or fix the property and sell it at a later date, you are not investing in a house. You just bought a house. Same way you can buy a car or buy some tacos. I don't know. So there's two ways to really invest in a house. There's flipping the house, as I mentioned, buying houses, fixing them up, and selling them at a later date at a higher value. With this, you're following the market as well. You're hoping that your home appreciates in value. Uh, if it was worth $180,000 when you bought it, and it's worth $210,000 by the time you sold it, and you add the repairs and that adds an extra amount to it, then you've made money on that house. So as for rental properties, this is more just buying and holding on to property. You buy a house or a condo or a unit or whatever you can get, and you rent it out to people. Now you're trying to rent it at a greater value than what the rent is, but also at a greater value than what all the repairs, etc., are going to be on the house. If you're hiring a property manager, you want your rent to cover that as well. Now that would be rental property investing. There is a third way to invest in real estate through something called a REIT. Now a REIT is not actually owning a piece of property. You can't touch it. It's kind of like the stock market, but it's not. It's a REIT. This is when you buy shares in commercial real estate portfolios. Portfolios are just something fancy people call for their combination of stocks, bonds, real estate, and all their investments put together. Someone else manages all these properties, you buy a share of that, and then you get to share in the income of all these properties. You got to match the real estate market against the stock market. I'm not really sure how to do that, but maybe I'll research it. That can be another video. Those are the two differences in stock market trading and real estate. Now, with stock market trading, your money's more what people call liquid. You can get to it at any time. It may not be smart because you want to tend to hold things over the long period of time, specifically when things look really bad. That's probably when you want to buy more, honestly. Yeah, so in the stock market, you can sell your shares at any time. You can sell your bonds to other people. You got a mutual fund you don't want, sell it. ETFs you don't want, sell them. You can get your cash out. That makes it some people more comfortable because, they want to get their hands on that cash at any moment. They want that freedom. They want to feel that they can go at any time. With real estate, your money's less liquid. It's kind of tied up in properties, right? You bought a house, and now you have to either live in the house, find people to rent the house, or wait to get the house sold. So in the meantime, and houses aren't cheap. So let's say that couple $100,000 that you spent on that house is, you're not going to be able to reach it for a while. You're going to have to wait on time, circumstance, realtors. But in the long run, you're making bigger cash moves at one time with real estate. So you may make a $10,000 mistake on Wednesday, but by the time you fix the house up, you may have made back $60,000, hundreds of $1,000s. Just depends on the rate of inflation and what you're doing. So for stock markets, get your money at any time. Real estate, you're making longer plays. So yeah, I hope any of this information was helpful. I'm definitely going to be working on my video formatting in the future. So thanks for being patient with me. Feel free to subscribe if you want to get more financial information. Comment down below in the descriptions what you'd like to see next. I do read the comments, so I look forward to seeing what you have to say. Stay fire. This is D the Firefly, signing out.